I just took a trade on euro dollar short. This is the PNL on a prop account, and then here is the PNL on a live account. And let me tell you why I think this could be the good play for the next 1, 2, 3 months. So the trade is actually me trying to go long the dollar more so than actually short the euro. So let me go ahead and show you the technicals and fundamentals on why I think this is a very solid idea. So just looking at the dollar index from a wide lens here, you can see that the market has been range bound for a long time since April of 2025 here. And if you zoom in here on the daily time frame, you can see here that we are now reaching a level of resistance that has capped the price before in the past. We are now breaking out of that level. You also do have the 200-day moving average as dynamic support as well. And if we do get that breakout, I am going to be targeting something like 100.5. That's going to be the next cap. And so because I'm really trying to catch this move here, this dollar strength, I'm actually going to be shorting the euro dollar. Now, the reason being is because the euro dollar makes up about 40% of that DXY basket. And so the euro dollar chart is actually pretty much the inverse of the DXY chart here. So you can see that that breakout to the upside is going to be this breakout of support here on the downside for euro dollar. So I do have my stop right above that 200-day moving average there on the euro dollar. And I'm going to be targeting about 1.15. However, 1.14 is going to be that 100.5 level on the DXY. So I'm going to be moving that take profit if price continues to move in my direction. And so transitioning onto the fundamentals here, you still have an elevated price of oil here up 2.83%, getting close to that 100 handle. So that elevated oil will transition into inflationary pressures. Inflationary pressures will go ahead and promote yields to stay elevated. And so you're seeing that here on the US 10-year yield, elevated yields here. This is where the war started and we are now up here. And that's going to cause the Fed to go ahead and be on standstill or even hike rates. And hiking interest rates or keeping them steady is actually strong for the dollar. Now, when you're trading in currencies, you're trading in currency pairs. So you need to be aware of the other side of the coin there, and that's going to be the euro dollar. So just speaking on the relative terms here, you do have US interest rates here in blue, and then in red, you have the Europe interest rates. You can see that the US is very well elevated above Europe there. So even if Europe does go ahead and hike their interest rates, which they are looking to do with a 95% probability on the next meeting in June, the US is still elevated by a wide margin. And also, too, the US is looking to raise their rates as well. So if Europe raises the rates, but then the US also raises the rates, the spread is still the same, right? So that's going to be helping the dollar there. And when you're talking in currencies, money over the long term flows into the higher yielding currency. And so right now, the US dollar is winning that relationship.